All right, we're on chapter 9, receivables. So, just a really quick reminder, let's kind of talk about where we are at in this accounting equation. Okay. Remember, our assets are broke out between current assets and long-term assets. Receivables are going to be right here in the current assets. Towards the end of the chapter, we'll look at some notes receivables. Remember the difference between notes receivables in the current means they're due. They're going to be paid within a year. If they're long term, they're more than a year. Okay. So in this chapter, we're going to do objective 9.1 and 9.2 together, and then 9.3 and 9.4, and then we'll do 9.5 in a separate video. Okay. So let's talk a little bit about how receivables come about. Okay. Most of the time, a receivable comes about because you sell something. You are have extended credit to the customer, and we want to do that because usually when we extend credit out like that, we make more money. We have more sales. Okay. So we're going to talk about how to account for accounts that go bad and they don't pay us, but it's still better to extend credit and risk. So, like if we had just a really stringent credit policy and we just said, no, we're not going to give anybody credit, we would probably lose a lot of money in revenue, and we don't want to lose revenue, right? So, we take that risk on by extending credit to our customers. Okay. So, a receivable occurs when a business sells goods or services. Remember, it could be either one on account. Okay. The receivable is a monetary claim against the business or the individual. Okay. Receivable is a right to receive the cash in the future from a current transaction. So a creditor is a party who receives the receivable. The debtor is the party to a credit transaction who is obligated to pay later. Okay. Most accounts receivables are going to be 30 days. Okay. You might see 60 days or 90 days. That might be something like really big. I'm thinking like, maybe they purchased like a ginormous piece of machinery and they may have gave them 90 days to pay, but very short term, no interest is involved in accounts receivable. So let's write that out. Okay. No interest is ever involved in accounts receivable. If there is interest involved, then it needs to move over to a notes receivable. Okay. Which is right here. Notes receivable. They usually have longer terms, have an interest rate. They could be short term, they could be long term, as I just mentioned when I drew the accounting equation out for you guys. Okay. There could be some other receivables. There could be a dividends receivable. To see a dividends receivable, we have to own stock in another company's business, and we're going to get that dividend. Okay. We may have an investment and we are going to receive some interest. We may have already earned the interest revenue. Remember, that's part of those adjusting entries. So we will have an interest receivable and we could have a taxes receivable. Okay. We do have to be very, very careful when it comes to receivables, and we want to make sure internal controls over those receivables are good. And we just got off of a chapter talking about internal control and making sure that we keep a good control over that, because there's a lot of things people could do. So you could have somebody who's working in accounts receivable and they're receiving checks or whatever they're receiving. And remember that ARC, authorization, recording, and custody. If they're receiving the check and making the journal entry, that we've crossed those two functions together. Okay. So we have to be very careful. Remember, small businesses usually cannot set up the most perfect of internal control systems. Okay. So you can have somebody receiving that check and, they might steal the check. Let's just say that they steal the first accounts receivable. We'll just call it accounts receivable one. They'll steal the money from that. The next check will come in from accounts receivable too. They may steal that one, and then maybe they'll steal the third one. And this is a system called lapping. So then when the accounts receivable for, when the money comes in for that one, they'll apply it to the one. Okay. And then when the fifth one comes in, they'll come back up here and apply it to the two. Okay. This is why I said the person who's never taken a vacation day in 20 or 30 years, that would be my suspect number one because they have to be there to continually cover up this fraud. Okay. So internal control over accounts receivable is very, very important. Okay. So they're going to give us an example here of a journal entry, and it says Smart Touch Learning provides 5,000 in services to Brown on account, sells 10,000 of merchandise inventory to Smith on account on August the 8th. They want us to ignore the cost of goods sold. Remember chapters 5 and 4. We were making merchandising inventories. If they don't tell you to ignore that and they tell you what the cost is, they're probably going to expect you to do that entry because that was in a previous chapter and they expect you to know. We're on chapter 9. They expect you to know 1 through 8 at this point. Okay. I know we missed one of those chapters. You'll be fine without that one. Okay. So on August the 8th, they debited accounts receivable for Brown, $5,000, credited sales revenue, and then they sold some goods, debited the receivable, and credited sales revenue. And those are two different lines on the income statement. They're both revenues, but they are different. Okay. So, a lot of times, what we have when it comes to accounts receivable, we have a control. Sometimes they'll call this the parent account. Okay. And they have two accounts receivables. They have like a subsidiary ledger of all of these accounts, and the total is 15,000. This is what will go to the financial statements. Okay. Just that total. They're not going to list the hundreds or thousands of customers that owe them money in the financial statements. Just that one number. Okay. So then they said when the business collects cash from both customers on August 29th, 4,000 from Brown and 8,000 from Smith, they're going to make the entry. I probably would have made this in two separate entries, not one, because this is probably going to be two different checks here, but you never know. They might have a system where that works. I wouldn't do it. You want to have as much information so that you have a paper trail. Okay. And then they're crediting those accounts receivables. Remember, the receivable just holds it until the customer actually pays us. Okay. If we were under a cash basis of accounting, we would not we wouldn't worry about it. Okay. We wouldn't do the accounts receivable. We would just record the revenue when we get the cash. Okay. Kind of show, so you kind of see now those accounts have a balance of 1,000 and 2,000 in there, and that is the control or parent account has a total of 3,000. Okay. Decreasing the collection time. Okay. So we kind of talked about this a little bit in the previous chapter because we talked about credit card and debit card sales. That actually gets the cash to the business a lot faster. Like I mentioned, Walmart accepts Visa, MasterCard because they want to get their money faster. Okay. There's also a thing called factoring or pledging receivables. This is not a great thing when a business has to do this because if I'm looking at the financials and I say they're factoring and pledging their receivables, what does that tell me? That tells me they don't have enough cash to pay their bills right now. So they're having to pledge and factor these receivables so they can pull some cash in and be able to pay their own bills. They don't have time to wait even though it's a very short turnaround, that makes me think that they are close, like they could be on the verge of bankruptcy. Okay. They're having a hard time paying their bills. And we've all been there, right? All right. We're going to move on to learning objective 9.2. And here we are going to learn about the direct write-off method. Okay. Before I get too much further, I want to write out a little triangle. I haven't ever seen this in a book, but if it is there, they stole it from me. There's some ways to keep up with bad debt expense. We have two broad ways. This objective will be the direct write-off method. Okay, direct write-off method. Then there is the allowance method, and then there are two allowance methods. Okay, one is called percent of sales, and the other is aging. Sorry about that. Aging of receivables. Okay. Sometimes this one is called the income statement method because we use an income statement number, sales. This is sometimes called the balance sheet method because we're using a number from the balance sheet. Okay. I can argue either one of these, but really what it's going to boil down to is which one gives you the better estimate. Okay. So let's dive into direct write-off method. Okay. So, um, direct write-off method really is not a gap method. Okay. Doesn't mean that you can't use it because you may be a business that does not have very many bad debt expenses. Where I worked at the hotel, we had very few bad debt expenses. Even when a customer would write us a bad check, sometimes we'd make money off of it because we'd turn them into check law and they would collect enough money to give us a little kickback on it. Okay. There was a handful of times that we had to actually write some really big bills off. I'll kind of show you how direct write-off method sort of violates gap just a little bit. So if you think about, we have revenues. Remember how matching we want to match the expenses with the revenues. I'm just going to say income right here. So this actually happened. We had this guest who had some sort of trust that was paying us, but he stayed in our hotel for quite a long time. There wasn't anything wrong with him, even though we were a medical hotel. And so let's just say, I know it was more than this, but let's just say in year one, and we literally had to kick him out of the hotel. So when he left, he owed us $1,000. We're going to record accounts receivable, and but we had $1,000 of revenue from that. Just because we didn't get the cash doesn't mean we didn't have revenue. We're going to assume everything else is just nothing, so we can sort of kind of see the tree for the forest on this one transaction. We get down to year three, and then we're going to write it off. Okay, direct write off. We're going to write it off. You can see how now we had the revenue here in '01, but we had the expense way over here in '02. We could still use it because this was a very immaterial amount. It would not have made a big decision making if we had used an allowance method and sort of took an allowance, because allowance is just an estimate. Okay. But that really happened. We ended up having to write it off after a couple of years. We were like, his trust fund dried up and there was no money to pay us and nobody. So we had to write it off. Okay. All right. So let's sort of get into the mechanics of writing off a bad debt. Okay. August 9th, Smart Touch Learning determines that it will not be able to collect $200 from customer Dan King for sale of merchandise made on May 5th. Okay. So bad debt expense is what we're going to debit. That will go to the income statement, and then the accounts receivable will go down. Okay. So then what if Mr. King comes back and says, "Oh, no, 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 I want to make sure I pay you." Now realize that once we write it off, we probably aren't just writing it off and be like, oh, that's sad they couldn't pay us. We're probably going to sell that account to a collection agency, and then that collection agency is going to threaten them until they pay it. We won't get the money from it. The collection agency will pay us a little bit of money for it, but that's what they're in the business doing. It's usually a lawyer behind the scene writing dirty letters saying we're going to take you to court because you owe this money. But a lot of students think, oh, no, 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 we've already wrote it off. We don't want their money. Yes, we do. We will figure out the journal entry. And sometimes this happens even in bankruptcy. A customer might be like, I really need to pay this vendor because they're not asking to go bankrupt and not have their business anymore. They want to have their business and they want to keep a certain vendor to where they will pay them, okay? Because they want to make sure they establish that credit. So a lot of times in bankruptcy, you can't affirm a debt that you might have otherwise been released of, but you can say, oh no, but I really want to pay them because it is vital to my business. Okay. So the first thing we're going to do is reinstate the account. Okay. I have both of them up here. Notice that reinstatement of the account is just a reversal of the write off. Okay. You can see just an exact reversal. That will be the same every single time. Doesn't matter which method we are using right here, right now. Okay. Then we're going to take their cash. We're going to debit the cash and then credit the receivable. And a lot of you are probably thinking, but wait a minute. We debited accounts receivable here and credited accounts receivable. Why didn't we just debit cash and credit bad debt expense? If we'd have done that, we would not have created a paper trail to show that Mr. King actually paid his bill. This is a longer entry. We have to make it in two separate entries to show the paper trail that that is who paid their account. Okay. Or it would still look like he didn't pay it. Okay. So we do have some limitations of the direct write-off method. I showed you how it violates the matching principle, but it's okay. Some businesses are going to use this because it's not going to make a huge difference in their financial statements in the end. Okay. All right. I will see you all in the next video for Learning Objective 9.3.